Steve, 9% plus gains. We're pretty much there right now for the Dow. Do you maybe want to up that forecast given the stock performance today?
Well, we weren't there this morning, or nearly as close this morning. Now, we've had a pretty stable expectation, pretty stable forecast for the economy and for the markets coming into 2011. We've done a lot of homework over the last couple of months, taking into account a lot of factors, and we feel pretty comfortable with that plus 9%, and that's what we're advising our clients. If we come in a little bit ahead of that, we'll take the gravy. But right now, we think that a reasonable multiple on reasonable earnings, that's a reasonable equity return forecast for 2011.
Are you surprised that markets have held up as well as they have? I mean, 9%, that's above the long-term average, I think, year on year for the S&P and the Dow.
Yeah, it is a little bit above, but also earnings are pretty strong. You were alluding to that earlier. You've really got this tug-of-war, this really intense tug-of-war between headline risks or those news items like the European debt crisis, what happened in Japan with that terrible earthquake and the tsunami. Also what's happening with the political negotiations in the United States and housing. But then on the other hand, you've got an economy which is growing in the United States, and you've also got corporate earnings which are doing extremely well. So probably one of the most surprising data points to most people is how well equity markets, and specifically how well the United States has held up year to date.
Yeah, that is a very good point. Let's go through the numbers and the earnings then, Steve, because we got some pretty good numbers from Apple and IBM. I'll talk about the tech sector a little bit later on. But what about the financials? I mean, take a look at Goldman. Basically the giant on Wall Street disappointing them, BOA losing some big money. But yet Russell Investments likes the sector. What's the explanation here?
Well, we do like the sector. First off, there's the global benchmarks. So financials from a global perspective and a U.S. perspective, they're a reasonably large percentage of benchmarks that you kind of measure yourself against. But then also there's some valuation opportunities. I mean, it's going to be really a lot of homework. It's going to be tough sledding. But when valuations come in, looking balance sheet by balance sheet, looking at those strong franchises, very stable business models, we think for the longer-term investors, you can get to that benchmark wake through some active stock selection. Not saying it'll be easy, just saying that there might be some long-term benefit for a lot of people there.
All right, what about technology then? Because that's, I guess, more of an upbeat picture. Because take a look at what happened for IBM and Apple, of course. IBM and Apple seeing their share prices rise to records. Do you think this is a case maybe of buying on speculation and selling on the news?
Well, markets usually work that way, so I think this would be very similar. We're getting a lot of good stories out of technology space. You mentioned a couple of prominent ones today, and those are big, prominent bellwether names that are really going to set the timbre, I think, for a lot of the sector, if not the markets overall. But you had the LinkedIn IPO a number of weeks ago. So we don't think this is 1999 all over again, but you're beginning to see some stabilization there. You're seeing very clean balance sheets. You're seeing great international franchises. You're seeing a lot of revenue drives. And when you look at names, even like an Apple, to some degree, these are pioneers, but almost like fashion companies in a way, too. They're really setting a lot of the trends for younger people. So I think you don't have a lot of debt overhang with these names. So in an active management space, we like what we see there, but we're also looking globally as well.
Okay, looking globally. Now, Steve, I'm going to give you 30 seconds here, but leave me with this. Just in the next 2 months or so, what are the biggest things you're watching out for the markets?
I think we're going to be looking out at what's going to be happening in earnings. We've been hit by a lot of these headline risks, debt ceiling, soft patching in the United States, housing, unemployment. But that's still being balanced by the fact that corporate earnings are going to be very close, if not this quarter, next quarter, to all-time profitability. Ultimately, stocks are going to trade on earnings, economic growth, and interest rates. And right now, interest rates and earnings look pretty darn good, and the economy looks okay. So that gives us that reasonably positive outlook for 2011.